Let me ask you a question that most financial analysts are quietly avoiding right now. What if the next systemic crisis has nothing to do with interest rates, bank balance sheets, or real estate? What if it's already building, in the desert? Across global markets right now, there's a split that doesn't get enough airtime. On one side, Silicon Valley, where AI valuations are hitting multiples that rival the most aggressive biotech cycles in history. On the other, the Middle East, where geopolitical pressure is rising and energy markets are more volatile than they have been in a decade. These two stories look unrelated. One is code, the other is crude. But pull back the lens far enough and they're the same story. A violent repricing of what the world considers real value. AI has not made energy less important. It has made energy the direct feedstock of computation. And that single fact is rewriting the rules of global finance faster than most people are prepared for. Start with first principles. In 2024, Saudi Arabia committed $40 billion to AI infrastructure. The UAE's G42 signed a landmark partnership with Microsoft worth billions more. Most coverage frame this as sovereign wealth funds chasing the next trend. That framing is wrong. What the Gulf states are executing is a vertical integration play that Western capital markets haven't fully prized. They've always sat at the bottom of the value chain, extracting oil, selling it to industrialized nations, watching the margin get captured elsewhere. Now they're cutting out every middleman. They burn hydrocarbons to generate electricity. The electricity feeds GPU clusters. The GPU clusters output compute. They've moved from selling a commodity to selling the infrastructure of intelligence itself. Here's where Europe enters the story, and not favorably. After 2022, European nations made the correct strategic call to cut Russian gas dependency. The cost was permanent. Industrial electricity prices in Europe now average 120 to 150 euros per megawatt hour. The United States sits at $60 to $80. Gulf producers operate at $20 to $30. The 3 to 5 times differential isn't an energy story, it's a competitiveness story. Every large model training run, every inference cluster, every AI data center built on European soil costs multiples more than its equivalent in Abu Dhabi or Riyadh. The physics are non-negotiable. Here's the financial exposure. Global AI capital expenditure is tracking towards $635 billion. A sustained 30% rise in energy input costs doesn't compress margins at the edges. It turns that entire capital program into a cash flow problem at scale. But energy is only half the equation. There is a second physical input to large-scale AI infrastructure that almost nobody in financial media is discussing: fresh water. Training a frontier AI model at scale consumes millions of liters of water for cooling. A single hyperscale data center can draw over 100,000 cubic meters annually. The Gulf states have an answer for this that no temperate zone competitor can replicate: nuclear-powered seawater desalination. Saudi Arabia and the UAE operate some of the most advanced desalination infrastructure on Earth. They are converting infinite seawater into a precision industrial input. Think about what that loop actually means. Crude oil generates electricity. Electricity drives desalination. Purified water cools GPU arrays. GPU arrays produce compute. They have engineered a closed-loop system that converts a finite hydrocarbon into a perpetually renewable competitive moat. Now look at Ireland. EirGrid, the national grid operator, issued a public warning that data centers around Dublin could consume over 30% of the country's entire electricity supply by 2028. Regulators have suspended new data center approvals in the greater Dublin area entirely. The Netherlands faces the same structural wall. Amsterdam's surrounding region has imposed strict water use permits on large-scale data centers following drought stress and environmental pressure. These aren't hypothetical risks. They are operational constraints that are live right now. Less than 4% of global data centers currently exceed 100,000 cubic meters of annual water consumption. But every large AI cluster being built today will cross that line on day one. When Irish or Dutch facilities face operational shutdowns due to water restrictions, Gulf operators face no equivalent constraint. That's not a policy difference. That's a physical moat. The third structural shift is the most insidious because it lives inside the balance sheets of institutions that haven't recognized it yet. Modern credit markets are built on a foundational assumption that knowledge is scarce, that expertise commands a premium, and that specialized human capability is a stable, monetizable asset. A company with 1,000 senior software engineers doesn't just earn its current revenue. Its valuation reflects the expected future value of that team's compounding expertise. The decade of institutional knowledge, The client relationships, the accumulated edge. Banks extend credit against that. Private funds lever against that. The assumption has always been this kind of capability depreciates slowly. AI doesn't destroy knowledge, it destroys the scarcity of knowledge. When a foundation model can produce a senior analyst's week of work in 40 seconds, or ship a development team's month of output in an afternoon, what happens to the premium attached to that capability? It compresses. And when enough sectors compress simultaneously, the collateral underpinning billions in European private credit quietly becomes worth less than the paperwork says. This is where European private credit faces a specific, underappreciated exposure. A significant share of the 83 billion euros currently deployed in European private credit markets is sitting in mid-market technology outsourcing firms and SaaS businesses in Germany, in the Netherlands, in Poland. These companies went to lenders with collateral built on two things: proprietary software licenses and the valuation of their engineering teams. Both of those asset classes are currently experiencing the fastest rate of value compression in the history of enterprise finance. The bank books still say one thing. The market has started saying another. That gap is a timing problem, not an if problem. The shadow banking response to this has been almost comedic in its circular logic. Lenders have started requiring AI companies to post NVIDIA chips as collateral. The problem is structural: a 5 to 7 year loan backed by hardware with an 18-month useful life and an even shorter technical lifespan. Real estate holds its floor. Silicon doesn't. When an energy shock crimps cash flow and lenders move to seize the collateral, they'll find a secondary market that moves faster than they do. The assets will be worth a fraction of the loan by the time they clear. This is how a technology cycle credit problem becomes a systemic one. Every major financial crisis in history has been, at its core, a story about collateral repricing. When one generation's anchor loses credibility, capital flows toward whatever offers the hardest physical claim on real output. We have watched this cycle play out from gold to sterling, from dollar hegemony to treasury bonds, from bonds to real estate credit. In 2026, a new configuration is quietly assembling. The smartest institutional money, not retail, not passive funds, but sovereign wealth funds and the largest multi-strategy hedge funds, is rotating out of software equity and into three specific bottleneck assets: private power grids, nuclear generation capacity, and data center interconnection rights. This is not a coincidence. It is a recognition that compute is not the scarcest thing in the AI era. Compute is a high depreciation consumable. You rent it like a car. The genuinely scarce asset is the right to deliver electrons to a machine that will consume them at a rate that would have powered a small city 10 years ago. The ADNOC model in Abu Dhabi has made this architecture explicit. The Abu Dhabi National Oil Company is no longer primarily an oil business. It is an energy to compute to intelligence conversion machine. Oil generates electricity at cost. Electricity powers data centers at scale. Data centers train models, including Falcon, which now competes directly with OpenAI in Arabic and English, represent sovereign intellectual output. They have executed, over a decade, a complete value chain migration. They used to sell 1 barrel of oil for 1 unit of revenue. Now they convert that barrel into electricity, electricity into compute, compute into intelligence, and intelligence into recurring sovereign revenue streams that are not denominated in dollars, not cleared through SWIFT, and not subject to Western rate policy. This has a direct implication for what national creditworthiness means going forward. Sovereign AI capacity and the combination of cheap energy, fresh water, and compute rights is becoming a reserve asset in the same conceptual category as foreign exchange reserves or gold stockpiles. It doesn't appear on any IMF balance sheet yet, but it shows up clearly in where sovereign capital is flowing. Europe's position in this realignment deserves its own focused analysis, because the pressures aren't sequential, they're simultaneous. 3 structural headwinds are converging on the continent at the same time, and the interaction effects between them are worse than anyone in isolation. First, energy. The transition away from Russian gas was strategically necessary, but the resulting cost structure is permanent, not cyclical. European industrial power prices have settled into a range that makes large-scale AI infrastructure economically marginal at best. This isn't a policy problem with a clean policy fix. It's a geography and infrastructure reality. Second, private credit collateral quality. Europe's 83 billion euro private credit deployment is heavily concentrated in the exact sectors facing AI-driven intangible deflation. The loan books look healthy on the metrics that were designed for the pre-AI world, but the underlying collateral, engineering capability, software IP, specialized human knowledge, is repricing in real time. The lag between market reality and accounting recognition is where systemic risk accumulates. Third, regulatory sequencing. The EU AI Act represents a landmark in global technology governance, the first comprehensive regulatory framework for artificial intelligence anywhere in the world. Its objectives around transparency, accountability, and risk management reflect genuinely considered public policy priorities. The observable tension is one of timing and sequencing. While American and Gulf AI infrastructure scaled aggressively through 2024 and 2025, European AI developers were simultaneously adapting to new compliance frameworks. Two different prioritization choices, playing out over the same 24-month window, produce different resource allocation outcomes. Whether the long-run governance advantage offsets the near-term capacity gap is a question that markets are currently pricing in real time and without a settled answer. The GDPR precedent is worth holding in mind. European digital businesses faced genuine short-term friction after 2018. The majority adapted. A competitive digital industry survived and in some ways strengthened through the clarity that came with clear rules. Whether AI regulation follows a similar arc is the open question, and it is genuinely open. Step back and look at the full structure. On one side of the ledger, AI-driven productivity acceleration and a massive capital rotation into the physical infrastructure layer, power, water, compute rights. On the other side, a global credit system still extending loans against the assumptions of the pre-AI world. The old model said, knowledge is expensive, experience has a premium, software can earn 20 years of rent. That model justified lending to outsourcing firms, leveraging SaaS multiples, accepting engineering headcount as a collateral proxy. Every financial crisis in history has ultimately been a model failure, not a data failure. The data was there. The framework for interpreting it was wrong. The money that is moving first already understands this. Citadel has been rotating into energy infrastructure. Abu Dhabi's sovereign vehicles are acquiring interconnection rights. These aren't speculative positions. They are structural repositioning by institutions that have run the model and reached a conclusion about where the next anchor sits. For any investor or institution with exposure to this cycle, there's one clarifying question worth sitting with. Is the value you are holding built on the scarcity of human expertise, or on the control of physical systems that physics itself makes scarce? The first category is actively deflating. The second is actively appreciating. When you see headlines about Middle Eastern conflict, oil price volatility, or energy market disruption, don't process that as geopolitics. Process it as a physical audit of financial assumptions. The material world is repricing the paper world, and the speed of that repricing is faster than most consensus models are built to handle. The most dangerous position in 2026 is not inflation risk. It is not rate risk. It is model risk. The risk of using a 20th century analytical framework to price a world that has been taken over by 19th century physics. The laws of thermodynamics do not negotiate with discounted cash flow models. This channel doesn't offer investment advice. We offer the clearest lens we can grind for watching a world in structural transition. If this perspective sharpened your thinking, a subscription keeps more of it coming. This is Longview. Stay rational. See further. We'll see you next time.